Saturday, March 13th, 2021, Monaco 64, home of alternative economics and contrarian views. Today we're going to look at the fact that the ball right now is on the Fed's court. They have their FOMC meeting Tuesday and Wednesday this coming week. Just wanted to let you know that Billy is fine. He's upstairs. I got up really early today, went for a nice walk around the park, about an hour. I usually do it in the afternoon or just early afternoon. I go for a walk these days in order to keep fit. We still cannot go and play golf here in the UK, believe it or not. We have to wait until March 29th. And you never know, things could change. They could decide to not lift the lockdown by then. It's really crazy. I didn't go watch the US Open in 2019. I just bought the hat. I have played, though, Pebble Beach back in 1989. And I remember the exact day. Why? Well, because it was the day before the big earthquake, 1989 earthquake in San Francisco. During the day of the earthquake, the day after I played Pebble Beach, I was playing golf near Pebble Beach at a golf course called Poppy Hills. And I always remember we're in the middle of the fairway, standing in the middle of a fairway on a par 5. I was ready to hit my second shot. And all of a sudden, it felt like a train was going underneath the fairway. And we looked at each other and we thought, what was that? and then we got back to our cars after we finished the round. It was fairly late. And all they were talking about was the earthquake. So that's my story about the earthquake in 1989. I also happened to go watch the first game of the World Series that year, which was the Bay Series between the San Francisco Giants and the Oakland A's. So now back to more serious things. Yes, why is the Fed, why is the ball on the Fed's court? Well, because they have a problem right now, a problem that I would venture to say that many people didn't know was a problem until last year. Most people thought the Fed could just do as much QE as they wanted to. We never realized that the QE has to go through the commercial banking system, through the primary dealers. And the more QE the Fed does, it creates a problem. It also increases the commercial banks' balance sheets and makes them more risky, and it makes them like break adequacy, capital adequacy rules that had been implemented or have been implemented since the '08 crisis, because the banks got too leveraged. So last year, when the crisis broke out, the Fed gave the big banks, commercial banks, the too big to fail, the banks that are primary dealers, to the Federal Reserve. And they're not just American banks, they're also foreign banks. Fed gave them an exemption that they didn't have to count Treasuries as a risk asset, so that they could be exempt from this SLR, which is the supplementary leverage ratio. So they lifted that restriction, and then they had to, I think in June, they had to extend it, and now this restriction is expected to end. Not restriction, but this exemption from the restriction is expected to end at the end of March this year. I went through this a few days ago, something JP Morgan Asset Management, a note they wrote to their clients back in June last year about this problem. And it says a Federal Reserve announcement provides temporary relief to banks on leverage and capital adequacy. So basically what's going on now, There's pressure from the Senate, especially from Senator Warren and Senator Brown, saying that this exemption should be lifted from the big banks. I guess they don't understand that if the Fed is not able to do its QE through the banks, the cost of borrowing for Uncle Sam is going to skyrocket. Interest rates or yields are going to rise massively. It's going to show that the emperor has no clothes. It's going to show that basically interest rates are not only manipulated by the Federal Reserve, but by all other central banks. That all those people out there who give the excuse of demographics and excess savings for the reason why interest rates or yields are low, I think they will wake up and realize that the reason yields and interest rates have been so low is because of manipulation. The Fed's just doing QE, buying bonds, giving assurances to investors that they're always going to be there to buy bonds in order to stop yields or rates from rising. When the Fed does QE, you need to understand they buy from the secondary market. What's the secondary market? Well, the primary market or the issuance market is when the Treasury comes out every week and issues or borrows short-term treasuries, which are T-bills or notes or bonds. When they issue that into the primary market, the Federal Reserve does not participate. They wait until the commercial banks, these primary dealers or direct bidders, as they called, they wait them to buy that from the Treasury, to borrow or to lend the money to the Treasury, and then they come in the secondary market a day or two later and they buy these from the primary dealers. So that's how the Fed does it. And I speculated in my video a few days ago that the nuclear option for the Federal Reserve could be to buy directly from the Treasury. That would be, well, debt monetization. That's what they were doing in Weimar Germany. That's what they're doing in Venezuela and Zimbabwe. The government basically buying, lending to itself. Yes, the Federal Reserve is a special agency. It's a part private, part public. It's a hybrid. But it only exists because of the government, because of the Federal Reserve Act in 1913. So that would be a really bad signal, not only for the domestic U.S. investors, but for foreign investors. You know, it would be like crazy, really. It's like me lending to myself. It doesn't make sense, right? So let's see what JP Morgan said back in June, and this applies to now. It says the Federal Reserve announced on April 1st, 2020, it would temporarily exclude U.S. Treasuries and banks' deposits with the Fed deposits from its calculation of banks' supplementary leverage ratio, or SLR. The action is the latest aggressive measure by the Fed to help ensure the flow of risk and liquidity through the financial system. It is set to last until March 31st, 2021. So we've got just over 2 weeks. The Fed has temporarily excluded U.S. Treasuries and Fed deposits from its calculation of a bank's SLR. What is the SLR? The SLR is the measure of capital adequacy. Essentially, it measures in percentage terms a bank's ability to take losses on its assets. The formula is SLR equals Tier 1 capital divided by total leverage exposure. This change reduces the denominator in the SLR calculation and as a result temporarily increases banks' SLR. With more capacity in the SLR, it should increase the bank's ability to take risk. So another interesting question here And a lot of people have been asking me about Tier 1 capital and gold and the BIS, Basel III. 2 years ago, the same people that are saying that gold is going to become a Tier 1 asset this year were saying that gold was going to become a Tier 1 asset as per Basel III rules back in March of 2019. They said March 29th, 2019, gold becomes a Tier 1 asset, and it hasn't yet. So what I've done, I've written to, sent an email to the BIS. I haven't gotten a reply yet, asking them about it. So right now, we should forget about gold and Tier 1. I am going to talk about gold a little later and silver after we go through this Fed dilemma, conundrum, problem that they have. That's really a huge problem for the whole world's financial system. So what is Tier 1 capital? Tier 1 capital is a bank's immediately available capital that gives it the capacity to absorb losses. It is primarily made up of common stock, retained earnings, and certain kinds of preferred stock. Yes, Basel III, the BIS, could very well allow banks to have gold as Tier 1 capital. Maybe that's why JP Morgan has been buying gold. That's why JP Morgan has silver as well, even though silver isn't Tier 1 capital. But it's not certain. It's only speculation, I would say. I haven't seen anything from the BIS, any literature from them saying that gold has become or is going to become a Tier 1 asset anytime soon. So let's continue. What is the total leverage exposure? The total leverage exposure is the combination of a bank's on-balance sheet and off-balance sheet, not directly owned assets. This part of the calculation temporarily excludes U.S. Treasuries and Fed deposits. So I'm going to skip here. And this is a relevant question right now for the system, for the bond market. It says, why do banks need this change, permitting them to enlarge their balance sheets? If a bank sells a U.S. Treasury into the Fed's QE program, wouldn't that sale shrink its balance sheet? Not exactly. When the Fed buys an asset from a bank through its QE program, the Fed pays for the asset by crediting the bank with a Fed deposit. So technically, the bank's balance sheet does not shrink in a QE transaction with the Fed. The bank just exchanges one asset, a U.S. Treasury, for another, a Fed deposit, on the asset side of its balance sheet. That's why if the Fed wants to continue to increase its QE program, it needs to grant this relief. Put another way, for the Fed's QE purchases to potentially accelerate in the future, the Fed needs banks to have assets it can purchase. So banks need the ability to hold more assets in the first place. So we'll stop at that. It doesn't seem like these senators know about how important exempting the big banks from SLR is. Am I in favor of the big banks? No, I'm just trying to tell you what could happen. Why are treasuries and treasury yields so important to the system? Well, the bond market is a lot bigger. It's the biggest financial market in the world. It's not the stock market. And treasuries, especially U.S. treasuries, seeing that the U.S. dollar is the world's reserve currency, is at the base of every credit instrument or equity instrument in the world. The treasury yield is the risk-free rate of return off of which asset prices are calculated, not only for U.S. markets, but for markets all around the world. So the Fed has until Wednesday to really solve this problem. I guess you could argue until the end of the month as well, because it's March 31st. But they do have this FOMC meeting. If they don't say anything about this at the press conference or after their statement on Wednesday, you could see the bond market get even crazier. How will that affect gold? A lot of people point to the fact that rising yields are negative for gold because the real yields go up, and it's not as attractive to hold gold or silver. But I would say that I would agree with that in the normal fiscal situation for the Treasury, in the normal economy as well. I would agree with that if the economy was picking up organically, if the levels of debt in the economy were low, not only corporate, private, but also public. Yes, I would agree with that. But right now, we have an economy that is on its knees, an economy that needs trillions upon trillions of stimulus every 3 to 6 months in order to keep the general public from starving, a lot of people from starving, I would say, people who have lost their jobs. The 6.3% unemployment rate, that doesn't include all the people that have given up. That rate is more like 20 to 40%. So it's not a normal economy. The economy needs Uncle Sam to keep printing money. Of course, it's the Fed that does it, but Uncle Sam borrows and the Fed obliges. And it uses this QE process to keep borrowing rates low. But if interest rates start rising or yields start rising, it's gonna, the debt is gonna go through the roof. They're gonna have to issue even more debt. They're gonna be paying more in interest, so they have to issue more to cover the interest. And that can't be good for the dollar. And a lot of people think that would be positive for the dollar. Yes, we will have probably a crash in the markets, in the economy, but I don't think it's going to be positive for the dollar this time. Could be neutral. Maybe foreign countries, emerging markets might need dollars, but so will the Treasury need dollars. It could be the perfect storm where you see the Federal Reserve losing control of the bond market, where you could see actually the dollar getting hurt. It might be neutral versus other fiat currencies, but I would say that commodities, precious metals would do really well in such an environment, because there would be loss of confidence. And that's why I thought the price action in precious metals yesterday was really interesting. Am I saying this is the bottom for gold? No, but it was encouraging. I know silver didn't perform as well, but it came back quite well. It made, I think, a low at 25.30 or so, and it closed almost at 26, even though it was down on the day. But I thought the fact that gold earlier in the day, midday London or thereabouts, tested 1700. I think the low was 1699. And then throughout the day, as yields kept rising, I think we closed right near the highs in terms of the 10-year yield at 163. We actually saw gold rebound almost 30 bucks, which was very encouraging, I thought. So the last price I saw on Kitco or on my system was 1727, almost on the highs of the day. So yes, the ball is on the Fed's court. Yes, they have until March 31st in order to apply this exemption, to continue this exemption of SLR. I think if they want things to calm down, they'd need to announce something on Wednesday, March 17th, which is when the second day of their meeting, when they come out with the announcement, when Jay Powell does a press conference, right? Because I think they're in trouble. And the other thing that I was saying, that commodities would do well and precious metals, yes. If there's a dollar crisis, a bond crisis, if you remember well, the sovereign debt crisis in Europe in 2011, 2012, yes, yields went up. In Italy and all those countries that were involved, the peripheral countries, they went from like 1% to 7, 10 and more. And the gold price in euros was making an all-time high. So yes, you need to be aware that it's not necessarily a bad thing for precious metals when central banks lose control of interest rates. And one thing that's pointing me to this is that commodities still remain very bullish here. You can see the CRB index still at very elevated levels, still has a lot of room on the upside. What about the stock market? How come the stock market, the Dow especially, and S&P actually for that matter, made new all-time highs? Well, I would say it's just like the auctions this week went well. How did they go well? Even though the bond market is under pressure at the end of the week. Well, I think there's probably a lot of manipulation. The Exchange Stabilization Fund, they're trying to keep every hole covered in the dike, like the Dutch boy trying to stop the flood. I think that's what's going on. I wouldn't be comfortable having a lot of stocks, general stocks, common stocks right now. I'm not here to advise people on that. I still think I'm going to hold on to my miners, gold and silver miners, especially silver. I'm overweight silver miners because I think silver will outperform even more than it has in the last 12 months versus gold. And I noticed that they did well yesterday, the silver miners, despite the fact that silver was down. So that was also encouraging. So what else? Well, for tomorrow, for the live stream at 9 p.m. London, I'm going to try to focus on doing more Q&A. I think that will be a good thing. Try to take your questions more. I won't cover any subject myself in particular, so I'll just listen to you guys, try to answer your questions. I'm trying to get Rafi, see if he will be available. So it could be Rafi and I doing the answering. Let's see, he hasn't answered me back yet. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Facebook, Twitter, and all these other platforms below here. I wish you all a great Saturday. Take care. Bye.